How we doing? How are we doing? How are we doing on this terrific Tuesday? This is Dr. Gregory Clarke Sr. And as we continue to go through another comeback conversation, I wish to thank all the members of the Comeback Collective Circle that are in the building. Let me start shouting out people who are here. Oh my God, I forgot to make Mr. Johnson a co-host. What's wrong with me? What is wrong with me? What is wrong with me? None other, starting with Miss Nicole Johnson, who's always here. Appreciate her, appreciate her. We have Mr. Calvin Osasami in the building. What up, my bruh? Peace and blessings. Mr. Everett Guthrie, who I guess he in Florida, they get to experience some of our wonderful temperatures up here in the Northeast, because that polar edge is coming down, coming down. Mr. Ernest Sampson, the Jay-Z funeral directors. If you're going to go, you should go with his firm. Amen. Then we have my sister, my blood sister now, my elder sister. But she a Virgo like me, so you know she can rock out too. Miss Karen Clarke is in the building. Can't forget Miss Cooper, the Philadelphia fan that was probably enjoying a little Will Smith. For those of you who don't get here before we start recording, you know, we set the atmosphere. We set the atmosphere. So I know Miss Cooper was feeling that little summertime feel for her Philadelphia Eagles fans who didn't make it to the Super Bowl. But we're not here to talk about that right now. We're not here to talk about that right now. And the gentleman from good old Saint Martin, none other than Mr. William Richards. And so that's just for sure. So once again, we're gonna jump right into it. And since Nicole's already co-host, anybody else who comes in after, she can easily let them in. But we're gonna continue on the second half of what we started last week, and then we're gonna get into some of the insurance policies or some of the different types of insurances that you should have, that you have access to. Now we can't get through it. We're gonna be in insurances, I would say, for at least the next 2 to 3, maybe even 4 weeks. Why? Because the Dynasty Path, these conversations that we're having for all of 2026, we're not rushing through them. This is not a sprint. This is a marathon. And see, when you know for a marathons, you have to take your time. You have to pace yourself at certain levels. You have to make sure we're going to be interactive. So don't be surprised if I may ask you a question that I would say, you know, go to your anointed intelligence to go assist you with, so you can come back with a great answer. Because, you know, we're here about not only our ontological being, but we're here to be in a space to develop our financial literacy. So without further ado, let me start to share what I need to share. If I can find it, there we go. 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 And as always ask Miss Johnson. She always gives me the good voiceover. Oh, can we see my screen, Miss Johnson?
Yes, we can.
Excellent, excellent, excellent. So let us jump right into the fade. Now, last week I may go one slide back, so you may just have a reference point, or maybe it's not going to allow me to go. Maybe it's not. Okay, maybe it's acting funky. Hey, we're just going forward. So when you avoid unnecessary exposure, you start to recognize that risk is always a possibility. Risk is always a possibility. Please don't think that you're going to go through life and not have risk. Risks are always available to us. When you wake up in the morning to get in your car and you feel like you're just driving down the road, or anything else that may happen over the course of life, every day we take risks. So why aren't we taking those, I would say, positive risks when it comes to our finances? Sometimes we can be so stuck in the status quo or stuck in what we have learned that we don't allow ourselves to have the faith to move into those next areas of exposure. So risk is not always wise. The reason why I state that, because you can make uncalculated risks that don't work for you. Like if someone wants to say, okay, jump off this roof, that's a risk. You wouldn't jump off the roof. So not every risk is wise. You have to calculate and recognize Where are the spaces that you should appropriately put your focus on certain levels of risk? And then at times to recognize, like, nah, I'm not going to put my money there. Nah, I'm not going to put my attention there. Nah, I'm not going to do that. That may negatively harm my health. Or nah, I'm not going to do something that may screw up my resources. Because, you take that moment and, even though this is not a Bible study, but as, it says in Proverbs, when a person can have the proper ability of restraint. Now, I know I'm paraphrasing. I think it's Proverbs 3, somewhere around there. When you have the ability to have some level of restraint, that shows a level of wisdom. Because that means you're not just jumping at everything that happens. And then when things don't go awry, you just stand there with your hands up in the air as if like, oh my God, I took a risk. You took a bad risk. So don't do that to yourself. So exposure comes from over leveraging assets, single income dependence, no backup systems, and concentrated investments. And one of the things that as you do even your own necessary research, you start to recognize that most individuals who are moving in the wealthy and affluent areas of possibility a possibility, have the ability to have different sources of income. So if you're only single income dependent, that's not good. And the only reason why I say that, because we all probably start at that space of single income dependent. And then after a while, you start recognizing, okay, where if you are a person that decides to get another job, so now you have two jobs. Now you have two income sources, which is good, but now you're spending more time, physical time, to get the same possibility. But if you start to leverage your time appropriately and properly, then you can start investing your money into other things and areas can start to grow around you without things happening. And I see Mr. Edward already has a question. Go ahead, Mr. Franklin.
So, Dr. Clarke, you talk about risk. So I'm pretty familiar with it, but could you explain, like, when you said where you don't put yourself in a position where you throw your hands up? Can you explain how we would move before taking that risk?
Well, just like I stated earlier, and it's a great question, Mr. Franklin. One of the things that I would say is that every single day we take risk. Every single day. When we wake up in the morning, we are at risk. If you go to the gym, and if you're going to the gym just to take care of your body, you're at risk. You might drop a weight. You may slip and fall. You may be driving down the road. Possibility of an accident. There's risk involved. And insurance companies, even though we're not dealing with those type of insurances, always calculate, depending upon your driving record. If you got speeding tickets, hopefully you're not drinking and driving or driving impaired. All these different things impact your risk assessment. Everyone has a risk assessment. So the same way that we have a risk assessment and companies are out there looking at you from a risk assessment, you need to start to recognize that within yourself. What are the things that you're willing to take a risk in? Even being a business owner, as an entrepreneur like yourself, you take risk every day. You make decisions every day that are around risk. Should I invest in this? Should we take this job? Should we not take this job? All these things are levels of risk. And now after a while, when you start to allow yourself to become seasoned and start to recognize what type of risk are you willing to put yourself into? Are these calculated risks of some level of benefit that I will see a result that will benefit me? And that's what most people do every day, regardless if you're in the stock market, regardless if you work in the corporate environment, regardless if you're a teacher in the school, teaching in the classroom, regardless if you're a nurse taking care of patients, regardless if you're an entrepreneur. We all take risks. So when you hear me talk about risk is not always wise, everything in life is a risk. But now you have the ability of choice to say, am I going to look at this or I'm going to look at that? And even when you take a risk, a lot of our risks, if they move in the right direction, will yield a positive result. And you would sit there and be like, wait a minute, if I stood and didn't do anything, then I wouldn't have reaped this particular benefit or had the possibility of getting this possible more income into my hands, or a possibility to be a more of an investment, so that those things can go back out and come back even more pregnant. See, that's why I said we're going to keep talking about pregnant money. Pregnant money only happens because there was a risk involved. Now, we're not going to talk about biology, but we even know, even to create life, there's a level of risk. There's a level of interaction that happens. There's some sort of exchange that happens. And within that, in order for the egg to get fertilized, there's how should I say, there's some possibilities of swimming happening. But there's a level of risk involved in that. So even in life, even from a biological standpoint, we can see how risk is a benefit to us, but we make more calculated and more well thought out risks, then we shall see those results work out for me. Hopefully I answered your question. And now we go to strategic positioning, diversification across assets. That means even if you're in the stock market, you don't just throw all your money in one company. You start looking around, you start figuring it out. I would say the most easiest way to do is sometimes look in your own household. Look at what you're willing to circulate your dollars upon, and then start to do the investigation. Yes, you have to put in some work. It's not just only your financial advisor or some of these apps out there that give you assistance that you just rely on their information. Sometimes some of the best results of what you are doing start in your own home. So are you diversified? You start to see what are the different things within your home. That's diversification. You don't have just one thing in your home. You have many different things that allow you to function in your home. So the same way that should happen in your finances, in your habits, in your movements. And if you have that level of diversification, then you're starting to see how well-rounded you are, because, the same soap that you may wash the dishes with is not maybe the same soap that you're going to wash your clothes with. So there's differences. But there's still soap. It's still soap. Or the same soap that you may even use on your body. May not be the one that you use to clean your dishes or to wash your clothes, but it's still soap. There's a diversification. It's diversified. And when you start to look at all those multiple areas in our respective lives, you get to be even more wise and say, oh, because of these choices that we make as a family, oh, I've noticed some of these companies might be public companies. Oh, what would happen, if we take some of our finances that we want to come back pregnant and we put it out there? Because it's going to be at risk anyway. So why not put it at risk where if it's calculated and we're being well-rounded and we're stewarding properly? As you can see, we're going to get to that line on the bottom about stewardship. If we're stewarding properly, then we have the ability to see a return. And those who move in wealthy and affluent ways, not just rich. We don't desire for you to be rich. Rich is easy. Rich means that you can have a lot of currency around. That doesn't make you wealthy. And it definitely doesn't make you affluent. It makes you rich. That means you could be in the top 10%, maybe top 15% of those who are the wage earners. But as we have learned over time, and as we're starting to see, and I'm going to ask someone to give me that question, to be able to answer that question for me. And whoever gets that, and then when I come back and ask for the answer, you can use your anointed intelligence. Tell me how many wage earners who make $100,000 a year or more live from paycheck to paycheck. I want the percentage. I'm not worrying about demographics. I'm not worrying about black or white or yellow or green or blue. I just simply ask a question and when I come back and I'm gonna ask someone to say, who has the answer to my question? Because you'll see why that correlates back into once we really jump into the insurance part of tonight's teaching and share. But
would that be ballpoint or precise?
Ballpoint.
Okay.
As you get whatever you utilize for research, some people have different tools and things of that nature. They have certain accesses that they have, Karen. And, just allow yourself just to ask that question and see what comes up. See what the data. See, one thing about us is that the data doesn't lie. See, we can be moved in our emotions. We can be moved in those areas that we can be in all the theatrics and can be like, oh my God, the sky's falling. The sky's not falling. The sky's never going to fall. Now, the reason why things may seem like it's in an anxious state around you because of your own movements. Now, if you lessen those movements, which means you start making better decisions, now all of a sudden those better decisions start to give you better results. So from risk transfer mechanisms, predictable income streams, because even certain people have predictable income streams, even as investors. Some people may play the bond market. Some people may play other aspects, other derivatives in certain markets which generate income. Some people may get T-bills, which means that they're investing into the United States government, and the government gives them bonds. And then those bonds, they get a certain amount of interest ever so often, which produces some level of income depending on how many bonds that you have. And all of a sudden, some of those bonds, they don't get taxed at the federal level, state level, or local level, because you're technically lending money to the government. So when you hear about treasury bills or T-bills and you hear all those yields, why is it yielding this one day and yielding? It depends upon the day, depending upon the movements of the economy. So when we start to recognize that, it is up to us to be self-aware. No one can, the government is not going to show you or tell you this information. You have to seek it out. It's like power. Power is never given. Power has to be taken. If you're not willing to go get power or take power, you're going to be stuck in the space. Let's see. I see some hands. Oh God. Okay. We're not there yet. Okay. As we're having some fun with these tools. Okay, let's stick here. I was about to click to that to see certain people in the chat. And you should always have multiple safety nets. That means even after you start to get in a space where you're generating some income, just because you generated income, okay, you made some money over here, that means we get to spend it off all over here. No. That's unwise. That's unwise. That means you're still moving in a risky way. Even though you made some profit, you may have made a tremendous profit. Part of that money should be going back. So, okay, I'm sending you back out to come back more pregnant. I'm sending this back out over here to come back more pregnant. I'm sending that over there to come back more pregnant. Not to be disrespectful, but to recognize, to be fruitful and multiply. If we're going to be fruitful and multiply, what are we doing to be fruitful with our resources? Not just in creating humans, which is excellent as well, but we're talking about those resources that you have the ability to responsibly take care of this that you're creating. And not all risk is faith. Some risk is neglect. Wise stewardship means protecting what you built. And see, when you're in the space of being a creative or being in a space where you're allowing for certain things to manifest around you, you are responsible for protecting what you built. You could have some of the greatest and wonderful ideas under the sun. But if you're not doing the appropriate or calculated risk for that thing to really get the light of air, or you're just being happenstance with what it is that you have, then in the long term, it's not that you had a bad idea. It's not that you didn't have good possibilities. It's that you had bad management. You had bad movements. You made bad choices. And when we can take responsibility of those choices and then start to say, I'm going to evolve from making those bad choices. And if you start making that evolution happen, you'd be surprised all the great stuff that can happen to you. So now, life insurance as a financial vault. We are reframing the tool. It's so important because sometimes we hear life insurance, and especially in our communities, or even sometimes, and a lot of times I've heard this a lot, and sometimes even Caribbean communities where, oh, I don't want to hear about life insurance, and you're trying to kill me off and all. No, and no. The people who are wealthy and affluent know that is part of their overall strategy. And I know Mr. Sampson is here. He deals with that from a funeral home, from a funeral diaspora. Whereas it's even wise of you to make sure you even have funeral insurance. So probably definitely before the end of the evening, I'm gonna ask him to chime in about that as well. And you say, why would I get funeral insurance? Wait a minute, you know how expensive it is to bury someone? Even though we're not even, and that's a form of life insurance. That's probably a particular policy that helps the shepherd that you make an investment in. It means yes, you got to give some resources up. You get nothing from nothing. You're not willing to put some resources at play, then you're not going to have that benefit or that possibility that happens that is inevitable for all of us. So just think about that. So life insurance is not just about death. It's not just for funerals. And it's not just for emergencies. Life insurance is a capital engine, a liquidity tool, we've been dealing with liquidity. If you wasn't here last week, you need to go back to last week's teaching, episodes 33 and 34 on my YouTube channel, and you saw that we dealt with liquidity. A legacy transfer system. You know how much wealth that you can transfer tax-free? That a lot of these families or sometimes companies or sometimes, because I've heard of plenty of times, some of these billion-dollar and trillion-dollar corporations, they have key man life insurance on their CEO. God forbid the CEO crooks, dies, transitions, goes on to be with the Lord. The business is going to get some money off of that because their key man has transitioned. So the company is willing to put that money on the line and says, wait a minute, we're going to make this investment. So God forbid, if something's happened to this key man, we still get some resources that we're going to keep reallocating and keep sending out to become even more pregnant. Now, of course, we're going to feel, we'll miss the individual, stuff like that. We're not going to be heartless and cold. But we must recognize when we start having the right conversations, especially about resources and finances, we start to get the emotion out of the way. If you're always emotional when it comes around money, you need to look in the mirror and check yourself. Always getting emotional. Oh my God. Hey. Are you emotional because you didn't handle it correctly? It didn't come back or work for you in the way that it was supposed to? But now you're emoting and now everyone else is supposed to deal with your emoting because of, no, that doesn't work. So the key insight, this is not about dying. It's about positioning. Strategic life insurance creates wealth transfer opportunities that preserve family legacies. It's about preserving legacy. See, you hear people all the time talking about, you're supposed to leave something for your children's children. Yeah, true. Well, where you left something from your children's children, from your great-grandfather or grandfather, and there's a high probability the answer may be no, especially if you're in Black or brown communities. And it's not the saying that your abuela or abuelo was wrong. Not making them wrong. It's just that there were certain conversations and certain things that weren't well positioned in our community. And now, as we're making ourselves abreast of those conversations, we're taking the ball by the rein. We're not sitting here just waiting for someone to show us or tell us and wait for you to be nice to us because I'm a nice person. So what? But being nice has nothing to do with being strategic. You better be wise with your movements. Types of life insurance. And these are the ones that we're really going to, kind of really express and get a little bit deeper in the later part of today's teaching. Types of life insurance, different tools for different purposes. Number one, term life insurance, temporary coverage spanning 10 to 30 years with lower cost structure. It's ideal for income replacement and family protection during wealth building years. That means usually your wealth building years are your 20s to your 40s. So if you're in that stage, between your 20s and your 40s, then maybe term life may be something that you can have as a part, I didn't say the only thing, as a part of what it is that you're doing. Because now, depending upon you're still in those early years and the wealth building years, you might be able to, and we're going to have some examples that we will get into to show, some of the potential costs depending upon the level of coverage that you would like for yourself or that you are putting on your respective life. Number 2, whole life insurance. Permanent coverage that builds guaranteed cash value with predictable growth patterns. Creates long-term legacy foundation and financial stability. Best for lifetime protection and wealth accumulation. You see, there's 2 differences. Term, they're letting you know already. It's spanning X amount of years. So that means if you get a term life insurance policy and it's only 10 years, it means at the end of that 10 years, you paid that company that money. They were happy for you rendering that monthly premium. You need to go get another. Now, if you have whole life, depending upon how you had it structured and probably when you began putting it in there, even though you're going to keep paying for it, but then after a while, there's some benefits from that, which we'll definitely get into a little later. And now term protects today. If you're getting term life insurance, that pretty much protects you today. So if you're in your 20s to your 40s, that's what term life insurance is good for. It's just protecting you for today. It's not really a wealth accumulation tool. It's just, God forbid, as we say, you go out there because we take risk every single day. So God forbid something has happened to you and you have your term life insurance and it was definitely not of your own causes, there's a high probability they still will have to pay out the policy based upon the face value of what you have. And whole life positions you for tomorrow. Choose based on your family's generational vision. See, that's the key. That's the key part that I desire for you to get right there. Generational vision. Because we can be caught up on something that looks inexpensive. I don't want to call something cheap, but we can be caught up in something that's inexpensive, thinking that, we have a good deal. And you come to find out you have a bag of rocks. I'm just saying. Someone has to talk to you real. Someone has to talk to you directly, not harshly, not disrespectfully, but just to keep it a buck. Now, these we're definitely going to get into a little bit later, so we're going to skip this one because we're not going to deal with universal life or survivorship insurance. That's going to come up probably next week. And the capital pool. In motion, how the system works. Step 1, premiums fund the system. Consistent discipline builds the foundation. Regular contributions create the bedrock of your family's financial fortress. And as you can see on this wonderful picture on the right, this is about showing, it's not about showing opulence and things of that nature, but it's showing the possibilities when you are willing to grow and you do it as a unit. So you can't force anyone to participate in something that can benefit them because people are going to have their own viewpoints, mindsets, things of that nature. Now, if they get locked in, that's worth it. But if they're not locked in, you have to look, you can't sit there and start crying to the moon because they're not locked in. Keep it pushing. You got to keep it moving. Because if not, you're going to be stuck in this particular space and it doesn't benefit anyone in the long term. Step 2, your cash can grow tax deferred. No annual tax erosion. Your capital compounds without government interference, accelerating wealth accumulation. Step 3, death benefit transfers tax-free. Wealth moves intact to heirs or trusts. Because, sometime during this year, we're going to talk about trust as well. We're really going to get in depth about trust. Because especially we as Black and brown people we need to start creating more trust around ourselves. There comes a point in time when even if you're a real estate owner, that real estate shouldn't be in your name after a while. But that's not the conversation we're having today. I'm giving you little breadcrumbs to where we're going as we go across this whole entire wonderful year. We build liquidity before lifestyle. That's like someone having a Bentley parked outside the projects. That means they are showing their lifestyle while they're living in the projects. Ass backwards. Does not work. We position ourselves before we spend. And technically, we don't spend here. We circulate. You should make decisions. Anytime you even going into your regular supermarket, as much as that you may not like where the prices are, you have to make decisions. Wait a minute, why am I circulating these funds? What is it that I'm getting? Am I being a conscientious consumer? Or as I'm about to date myself, I think that was a company that's no longer here called Sims. They said an educated consumer is our best customer. Are you an educated consumer? Or are you just a consumer who just takes their money and says, I'm just going to spend, and then complain when you have no liquidity? Just something to think about. We protect before we transfer. See, none of us, regardless of whatever it is that we ultimately can create and develop while we're here on this plane, is like how we see certain individuals who are worth hundreds of billions of dollars, or even one that may eventually become the first trillionaire and stuff like that. And we know some of their names. We know some of these individuals because, if we're just aware from a social standpoint. But even them, those individuals can't take it with them. That's why they start creating trust. That's why they start creating areas of philanthropic pursuits. To say, wait a minute, I got all this wealth. Let me see if I can at least do some good on this planet. Let me give back some of this. I got all these resources. Kept sending them back out and becoming more and more pregnant. I got billions upon billions of dollars. Regardless, it may be worth in stock price, or because no one's running around with $200 billion in cash. So you have to think about the whole space of leverage. So even some of these individuals recognize it's what it is that you're willing to invest in and what it is that you're willing to be in partnership with, collaboration, own, so you can have access to the liquidity. Then you can have the type of lifestyle that's being presented in the image to the right. Just I'm saying. Not beating nobody up. Just I'm saying. So just think about that. And maybe you should start having some of these necessary conversations with your family members. Those who are willing to sit and listen. Because if they're not willing to sit and listen, okay, keep it pushing. But don't get mad at them. Just recognize, they just not down with it. But the only worst case scenario will be is that if they see you start to become moving towards that space that you're not just attempting to be rich, but you're moving into a space to create wealth possibilities and move towards affluency. Then they're going to wonder, like, aren't we family? That got nothing to do with it. Your loyalty to the situation, your loyalty to what it is that you're establishing when it comes to your own respective risk assessments is where it is. Now, if the family that is blood that wants to roll with you and come along, that's even better. The more, the merrier. But if they don't make them wrong and don't make yourself wrong. And that is the end of this particular slide for this particular moment. Any questions before we get into the next slide, the next conversation? Oh, I see Miss Johnson got a hand raised. Go ahead, Miss Johnson, before we go on to the next slide.
My question is, when you say leverage, what exactly do you mean?
Okay. Leverage is the standpoint of understanding that you may have some capital. That's like saying your credit card is leverage. And why do I say it's leverage? Your credit card is a great example of leverage. If you have a credit card and that particular credit card company or bank that issues that card says, your name based upon whatever number that's in a respective system states that we can offer you $5,000. And say, on top of that, we're going to give you a Visa card or a MasterCard, depending upon who we are utilizing as our issuing credit agency. And they decide to give you a Visa card. So that means any place that accepts Visa will accept your card. That means with that same leverage, you have $5,000 worth of buying power. Now, what do you do with that 5,000? Some people use that 5,000 and go buy things to impress people that they don't need to impress. Or some people may use a part of that 5,000 and says, you know what? I'm starting my business. I may invest in a computer. And then that computer may cost me $1,500. Now you have $5,000 as leverage. You access $1,500 of it for a business expense because you are desiring to build something that can bring some more pregnant money back to you. You start making some money, or you start making some possibilities. You start paying back that credit card company or bank, depending upon when you pay it off, or you're making payments over time. And as you can tell from what we said last week, you're going to make that type of decision. You can't pay it off within 4 months, and really should be 3, but we'll stretch it to 4. If you're making that type of leverage decision and you can't pay it off within 4 months, that means you're starting to fall into the credit trap. So yes, leverage is the ability to take either your own finances or resources, or the access based upon your name. That's why having a good name is beyond important. He said, I don't care. I'm just going to use my credit. No, and no. That's not good. You're not benefiting yourself. You're not benefiting your family, and you're creating a hole for yourself. Because if you use credit wisely, which most individuals who start moving towards wealthy and affluency do, when you start using credit wisely, all of a sudden, people are willing to say, I'm thinking about buying that company for $100 million. And you may be worth 80, 90 million. But most banks will sit there and says, wait a minute, this person is a high leverage, high net worth individual. Let him take his $80 million and go buy that company, and he'll figure out how to get the rest. No. Most wise banks will sit there and say, no, don't over leverage yourself. That's why we was talking about over leveraging one of the previous slides before that presentation ended. They'll give you the opportunity and says, you know what, because of your name, because of your track record, because of what you've done here in the marketplace, we're willing to give you 50 million. Oh, okay. So basically, I can take 50 million of my own money, take your 50 million, go purchase that asset, which that's debt. I'm going to take that asset, $100 million, and next thing you know, I'm going to work that sucker to its bone. I'm going to work that business. I'm going to be hopefully nice to my employees and this, that, and the third. And maybe in a year, 2, 3 years, I start paying down. Because remember, you put some of your money into this game as well. And now you're paying down that loan. You're paying down that leverage. You're paying down that debt. And all of a sudden, you pay that debt down enough, whereas now, wait a minute. I went from leveraging 50% of this company. So now, all of a sudden, you know what? We still have debt. It's only like 20% of the company. Means you own 80% of the company that has probably grown in value from the $100 million that you circulated. And maybe it's worth 200 million. And what ends up happening? Those banks start clamoring around. Oh, you want to expand this and you want to expand that? You desire to do this? No, we can get you some more leverage money. We can get you some more finances from the debt markets. And, you can use that to your expansion. Because as you're using that capital or that leverage to expand and you're paying down the debt, you still own an asset that's worth something. So yes, us in Black and brown communities have done it improperly, or we were positioned. I would say that. I'm not going to make us all wrong, because some of it was lack of systemic teaching and things of that nature that we're now starting to rectify. But yes, Black and brown people were positioned to use their access to credit or debt, which is leverage, to be consumers, which means you're using it just to spend, instead of recognizing that spending moves towards ending. But when you're investing, that means you have in that word invest, that means there's a vest. You're vesting in something. That means eventually, that means when you invest in something, that means you reside in it. You're in there. So when you invest, oh, I'm willing to be a part of this game. I'm willing to see, these resources that I put at risk to put into this investment can make enough of a return. And if I have enough of those investments out there, then I have so many greater possibilities to grow. So hopefully I answered your question, Ms. Johnson.
Yes, you did. Thanks.
You're very welcome. And does someone have the answer to my question? Who has the answer to my question about
Hey,
how?
brother.
Oh, come on, Mr. Sampson, look at the book. I should say, hey, Paris. That's the man from Paris. Paris. Man, who was able to have a great time. And once again, we want to celebrate the fact this man and his wife, lovely wife, celebrated 25 years of wedded bliss. We always give that celebration. So if y'all want to throw some
Bless you,
handcuffs
bless
out
you.
there, what I'm saying? We always celebrate. Let's see this heat. That's good. That's good. You know what I'm saying?
Thank you, everyone.
That's excellent. So yes, Mr. Sampson, what do you have to add? What do you have to add?
It says 35 to 40% of Americans earning 100,000 or more are living check to check. 35 to 40%.
Lord have mercy.
That's
Thank
a
you.
high number, Doc.
Why do you think it's so high? $100,000 a year, you should be good, right?
Well, when you were younger, one would think. When you were younger, I mean, we thrive to get six figures.
Mm-hmm.
The older and the more mature we get. Yeah,
Yeah.
and oh wow, under 50,000 is 75% of the people.
Come on. See what I'm saying? Now you think about that. And the reason why we have to have these relevant conversations is not that we're bad individuals. That's what I'm saying. Don't think that as I'm talking about our respective communities, like we're bad from a positional standpoint. No, we were positioned to be like this. And until we make the choice to say, you know what, we can't go down that road like that. We can't use the excuse or the okey doke. Well, my grandmama did this and my mama did this. Well, baby, your mama was wrong. Mama was wrong. Grandma,
Can I share one more thing, Doctor?
please.
200,000 plus is still 25 to 30% check to check. 200,000 plus. Double 100 you asked about, and you're still at 30% check to check. That's bananas.
Bananas. Exactly. You hit the word right on those. Bananas. And you think about, and it's not that those people who are making those type of salaries, because now we're talking about people with salaries. Because you start to recognize just because you have a high salary doesn't mean that you have a high net worth. But there's plenty of people out there that make 7 figures a year. But because of their lifestyle or based upon their choices or their decisions, they're in worse debt than someone that, as Mr. Sampson just alluded to, that's only making 50, 60, 70, 80,000 a year. Why? Because it's poor decision making. It goes back to mindset. It goes back to sometimes, are you over leveraging, over circulating, overspending to impress who? Who are you attempting to impress? Why? Why are you doing that? Okay, yeah, you may have the latest this and latest that. Wait a minute. Mm-mm. And I remember probably going back about 2 years, there was a book at one point that I was intentionally asking some of the individuals during that time to read. And this is a great time to still read it, even though $1 million is not as $1 million as it was when that book was written in 1995, 1996, but The Millionaire Next Door. You can find that on PDF or Kindle or whatever it is that you can find that, give yourself the stop just to browse to it. Remember, you're going to look at it from the gaze because this was written in the 90s, where $1 million was still, you can still do something with $1 million. $1 million today is definitely not $1 million in the 1990s. Just basic economics, basic erosion of value, and on top of that, that ugly word inflation. Because that's the kicker. Based upon how things keep being amplified in their price, and you still may be stuck at that same dollar point or the same salary point, that's when you start to feel the squeeze. So it's not that you're being squeezed because you're a bad person, or you did something wrong spiritually, or there's something wrong with you, or there's some sort of curse on you. Stop with that mess. No, you're being squeezed because your money is not keeping up with the rate of inflation. And part of it, what the wealthy and the affluent do, as we're about to get into the next presentation, part 2 for tonight, they utilize the respective different life insurance paths to kind of hedge themselves and to create those buffers and have added weight and have added things that you can have access to depending upon the type of thing that you have decided to put your premium dollars in monthly into.